prelims that have come in with respect to business updates. So deposits are up 15% YOY, but more than 5% on a sequential basis. The CASA is up 8% YOY and about 2.3% sequentially. However, due to higher non-CASA growth in terms of deposits, the CASA ratio has declined to 35.3% versus 37.6% on a YOY basis and about 36.3% on a sequential basis. So the time deposits or term deposits is up 19.3% YOY and about 6.7% sequentially. Now the advances growth have been tapered, and we have been seeing them selling their loan book sell down has been happening. So that advances growth is at 7% YOY and about 1.3% sequentially. AUM growth is at 8% YOY and about 2.3% sequentially. The entire focus looks to me on credit deposits ratio, which has declined sharply to 100.8% versus 108.4% in the same quarter last year and about 104.5% in the previous quarter. Even the liquidity coverage ratio, that's improved to 127% versus 123% in the previous quarter. Back to you.
These are decent and good set of ratios, especially the CD ratio, coming back to more reasonable levels now. Abhishek, thank you very much for that. I think we are just hitting market open, and we'll have the values coming up in terms of first rates in a bit from now. Lots to track. The market itself, the pre-open is left about 70 points lower, so 25,000, just under 25,200. And I think about 5 days back, we were at 26,200. So that's how quickly markets, of course, move nowadays. Just a few seconds, and we'll just read out the indices, and then we'll do stocks. What do we have? First rates, 25,211. It's a flattish start, 0.15 lower. The Nifty Bank is down about 0.25% and nothing. I think the Nifty is now turning into the green. Let's see. Bank Nifty 51,865 is where the Nifty Bank is at. The mid-cap index is absolutely flat, nothing, no change. So 58,964 in the mid-cap index at this point. The IT index, which of course will be first off the block in terms of reporting earnings with TCS next Thursday, the IT index is up 0.5%, 41,980 or so on that one. So that is a heavyweight. The Nifty heat map is coming up on your screen. I think it's more down than up, but this is the first 1 minute or so of trade. Market on the Nifty is already up about 30 points, which is a little better than how the absolute first rates that we got. So 25,270-ish on the Nifty. Surabhi.
The interesting rates are on companies that have come out with their quarterly updates. Watch out for Mahindra and Mahindra Financial. The market does not like any hint of deterioration in asset quality, which is exactly what M&M Financial has reported. Stocks down 4%, and Avenue Supermarts also down about 2.5%. So we'll sort of talk more about these updates and the impact. On the large cap screen, actually, speaking of updates, why I forget Bajaj Finance. Even here, despite that 29% AUM growth, the stock is under pressure, 2% lower, because the internals seem to be not that pleasing for the market. BPCL is cooling off after yesterday's sharp rally, 2% down. Trent, Asian Paints, Reliance. Reliance has had a very volatile start. Reliance was actually up, leading the Nifty higher on the green side when we opened, and it's immediately turned course, and it's down 1%. So intraday, this move is already about 2.5% on Reliance for such a big stock. Anyway, ICICI Bank on the lower side. There is some selling on HDFC Bank as well. So banks are not supporting, and the market has started slipping. There's Bajaj Auto, Hero Moto, the two-wheeler makers, Eicher, all of them on the way down as well. Nestle, Britannia, Tata Consumer. If you thought consumer will support, well, that is not the case at this point in time. On the upside, what remains is actually ONGC. And there's a fair amount of IT, like Prashant pointed out. So TCS, Wipro, they're still trying to provide some comfort and support. Tech Mahindra, minor gains. But otherwise, it's just cooling off. Barring ONGC, which is a very obvious move on oil and IT, the rest of it, banks are slipping, Reliance is slipping. We don't have too much support. And even FMCG, not really helping the bulls' cause, at least at the open.
Well, M&M Financial is extending its losses now. So more than 4% gone on M&M Financial. Apart from the worsening of the asset quality, even the disbursements for M&M Finance in Q2 were down 1% on a year-on-year basis, so a bit of growth concerns too. Angel One too is reacting adversely. That stock is open with a cut of close to about 3-odd%. Paint companies are hurting on the back of the rise in crude prices. So Kansai Nerolac, Indigo Paints are down 1.2%. EPAC Durable has gotten an order win or sort of an agreement. They will be manufacturing components for Panasonic ACs. It started trade in the green, but now has dipped into the red. So perhaps some of the up move has already played out, because this week the stock is already up close to about 7%, and the stock is practically doubled from its IPO price. Interglobe Aviation too is a bit subdued in trade, so that's opened with a cut of about 1%. Z Media, a stock which has had a one-way unstoppable move. Z Media today has corrected close to about 5%. And some cuts are coming through in real estate companies like Macrotech Developers. Real estate index, remember, has taken the biggest hit over the last 4 or 5 days. So Phoenix Mills, Macrotech Developers continue to remain under pressure. On the way up, it's ITD Cementation. Yesterday was up 20% on the back of that 1,900 crore order win. It's followed it up with another 5% gain. Sapphire Foods, JK Paper, these are stocks which are looking quite smart and seeing some pretty good volumes. Aarti Drug, Shilpa Medicare, even Uflex, where the company is planning to set up a plant in Egypt. The investment will be $126 million. Uflex is higher by close to about 1.5%. And Bank of Baroda, amongst the Q2 updates, Abhishek, remember, was telling us after a weak Q1, in Q2, growth has bounced back. The company's advances growth is 6.7% on a quarter-on-quarter basis. So Bank of Baroda stands out on the way up in terms of the quarterly updates.
Okay, well, those are lots of names which are coming through. Just a few more. I mean, look at the Nifty, right? We started absolutely flat, slightly lower. Then there was a 30 or 40 odd point bump. That's got sold into, and we're down about 80 points now. So 25,170 is where we stand at. So that's about 1/3% lower. So this is a more, not decisive, but a pronounced kind of reaction, for the first pronounced reaction for the day. Let's welcome in Samir Arora. He's joining us. He's a market master today, founder and fund manager at Helios Capital. Samir, it's good to see you. Thank you very much for being on the program. So I have two questions, and you are someone who's invested and watched not just India, but regional markets very closely as well, China as well. So let me start with that. Is this time different? That old question. It rarely is, but let me frame it that way for China. And second, I mean, is this a real thing? And second, flows. We saw some very large selling figures in India over the last 2 days, foreign selling. Is that on account of China as well? Go on.
So second part, not so clear, but first part is it can go on, I think. By the way, in our fund, we used to own Alibaba and C-Trip, and we bought more Alibaba even yesterday, because I think it can go on for some time. And actually, I don't think it's a bad thing if China market does well for us, as in mostly for India funds. But before that, so the China thing, first of all, the government has to take a call now whether they are going to make sure that they are able to revive confidence, revive this thing, or they make it as a given. They have the money, they have a lot of advancement in technology. They have to basically revive sentiment of the consumer. There was maybe some pressure even for people who are rich to not openly spend because of this shared prosperity and things like that. So if they let it go, like for India, for many years, we were able to say that although there is a big divide between the rich and poor, but at least the rich are doing premium and the care recovery and all that. So you don't believe that there are many super rich people and middle class and upper middle class, which all they need is the market. A market means the government and whatever to let them be as they are, rather than always show that they are, part of a shared system. So it can go on, I think. And maybe some pockets do it only, but it can go on because their market was really cheap. It was just that it needed a trigger. But I think it is not bad for India per se. I don't think that beyond some shorter term thing, investors have to sell India to buy China. Because India, I don't think in aggregate people are overweight. There might be 1% plus minus overweight. So if you were underweight China, that would have come from the rest of the world. India and China, even an emerging market fund combined would be, say, 20 and 25, 26 now. So half the investment of people who are able to move this around is in non-India, non-China. The other thing is, if the Chinese market does well, and if the US market does well, the Indian fund managers, the mutual fund guys, they will have less reason to sit on cash. Our premium to emerging markets, our premium to China has shrunk because the Chinese market is up some 25, 27%. So we are some 5, 6% cheaper than we were. Just to finish one more line. So I mean, the market used to say that Indian market trades historically at some 40, 50% premium to emerging markets. And in recent periods, it has become 165, 170%. So that does not mean it was 20% overvalued. That means it was 170 divided by 150. Correct? Because 150 is so it was 10, 12%. Let us say, if that was one issue, that it was 10, 12% more than the longer term average. Now that it would be, according to me, 5, 6% more than longer term average, just with China moving up 25%, because that would have shifted the valuation by 5, 6% at an index level for emerging markets. So I think you don't want China to blow up and feel happy on that. If they're doing that, it's okay. We may underperform, but we will not be in absolute negative.
But Samir, hi, morning. Great to be listening in to you. But the thing is, when $3 billion leave the market in 3 days, it does catch people by surprise, right?
Correct.
I mean, we were sitting on a high horse saying we don't need the foreigners and that's fine.
That
we have
need.
local
That
money.
need.
But exactly, I mean, we've forgotten what FII selling really feels like, and we got a nasty reminder since the start of October. How long can that continue?
But that's what I'm saying. I don't know whether it's related to China only, because there are 3 issues going on simultaneously. One is China, let's say, one issue. Second is that if people had some model on which they are doing this futures arbitrage and all these millennium kind of guys. And the third is that separately, I think it is going on in parallel that if you have more than 25,000 crores in India, you need 100% disclosure of your end investors. And many of these platform guys will have more than $3 billion and they have to basically reduce their weight in India. So who knows what is the exact reason? But I think the best answer for that would be to call some broker and ask him that, is it hedge funds who are selling? Is it long? Because my big picture thing, without overly knowing this, is that nobody does it like that. No regular long-term or even medium-term investor sells a market which is, at least in the last 3 weeks, zero, to buy a market which is up by the time he ends up buying it 30% higher. And mostly the stocks that he will like to buy are 40% higher. Mostly you do it a little bit more gradually. This kind of thing normally is a burst in the beginning. And that can be easily countered after some time with the domestic guy sitting on cash and some other guys who will feel that a 30% move is too big. I just think big picture, relative India-China flow is not going to do it, but who knows?
Got it. No, just one point. Hormuz was just telling us, he looked at the top stocks. He said 5 stocks basically were responsible for the, I think 70-80% of that 15,000 crore sell number. There was Reliance, there were the 3 banks, and there was, so very concentrated. And the fact that there were 3 banks kind of looks like it's foreign related.
No, of course it's foreigner selling, but the question whether it is China related or it is arbitrage related and other things.
Samir, hi, morning. So we're now almost approaching a near 5% cut from the top. And, at least in the last couple of years, we haven't seen a fall greater than 5%. So now investors are saying that, is this the time to buy stocks or buy any themes that they like? So, if you have to find opportunity now in this little bit of a correction, what would you recommend?
So first thing is that 5% correction can happen without a reason. If this 5% correction has happened for reasons like Israel attack or Iran sending missiles to Israel, or it is because of Hamas and whatever, and it is because of China having done this, then it's a pretty decent market that with only 4-5% fall, it has absorbed all this. So I think the market continues to be strong, because my big picture thesis is that India itself was doing okay. If the rest of the world is also doing okay, then there is no reason for us to feel too negative. The only issue could be this geopolitics, but as of now, even the oil prices are not that high, which show that there is an imminent attack happening, although President Biden said some few things which confuse the oil guys for some reason. But coming back to us, so we, first of all, have been more or less fully invested, so we don't have much. But the general big picture thumb rule would be, any stock that you own which is down 5, 7, 8% without any reason, you buy 0.5% more of that. For us, these stocks remain primarily right now in the financial sector, because the IT sector, we have just bought, now we have some 13-14% in IT, but we need to wait for their results and guidance and language and how they say, because we have all taken it for granted that the worst is over and that there'll be some improvement from here. But let us again hear it from them. And in consumer, I genuinely think that there is a slowdown and that there is too much competition, and we come up with a new excuse every month. Sometimes it is big rain, then big summer, then politics, then cold, because now they're saying it's very cold. So then they'll suddenly say, okay, let's buy some cream guy because somebody's skin became dry, so they want to buy those shares. So I don't like that. I like very, sort of somewhat reasonable prediction of growth, or sometimes very high growth, like these food delivery companies and all that.
Samir, so I just looked at this is, of course, as of yesterday's close, and maybe today numbers would be a little. So Axis, HDFC, ICICI, they've all fallen. Axis has fallen 8% from its highs. HDFC Bank 5.5%, ICICI 5.5%, Reliance 8% from the highs. Tata, and actually autos have taken a knock between 6, 7, and 8% average. Tata Motors, Bajaj Auto, Maruti. What you were saying, right? I mean, the pullbacks.
So I would say that
seen.
autos should fall 20% as far as I'm concerned, and they would still be overvalued.
Yeah, you've not liked autos for a while. Yeah,
and that is very blatant. I mean, it is just too much of living in our own world. But for financials and even some consumer here and there, you can add, we will add, or we have added.
Okay, all right. The other sort of thing has been earnings. So consumption is slow, but looking at some of the previews which have come in from specific sectors, generally it's expected to be a pretty slow quarter. Actually, people have mostly written off Q2. They're looking at H2.
So it's very easy to say now, as soon as the results are bad, to say they have written them off, because this whole quarter, the only stocks that went up were these consumer stocks because of good monsoon. Now they say there was too much monsoon. Actually, I have a bigger issue with this, which is to do with the fact that these traditional consumer guys, I think the basket of the consumer has changed into his, as in regards to his preference. So if there's more rain and somebody makes a few 1,000 rupees more, does he upgrade his toothpaste, or does he spend more on a phone or on something which he can show on social media or in a photo, or does he travel a little bit more, or does he, buy a more expensive shampoo or a soap? I think the basket has changed, and even this telecom price hikes have basically meant, say, a 300, 400 rupee per year price hike, say 30 rupees per month, multiply by 50, 60 crore people, and that is a big, big number that has gone to the telecom guys. So I think basically we are not interested in the old consumer companies where you are betting whether the growth is 3% or 4%. And that is also because of rain or no rain. And we don't like the consumer durable companies, because the consumer durable companies, the competition is just too much. Everybody wants to get into the same making of ACs and making of microwaves and making of air conditioners, from the the Japanese to the Koreans to every Indian guy like Reliance, Flipkart, all going to the same underlying OEM manufacturers to make under their own brand. It's just too much.
Yeah. I just have since we have you, and I must ask you, there's this new F&O curves, etc., which have come in. Quick thoughts, if any, at all, on how this is going to work out. We will see big fall in volumes. And your thoughts on BSE, Samir, if you have a view.
So actually, I don't know about BSE, I don't have it, but big picture, my thing is that the market in India has to, for a few days, play dead on those sectors or stocks where the government or the regulator is trying to do something which broadly is negative. So let's say you increase capital gains tax. If within 2 hours the market goes up, it gives confidence to the government that we should increase taxes even more because these taxes were ignored. In the same way, if SEBI or the regulator is saying, I think the futures and options volume is too much and I have to cut it down, and within 2 hours the broker stock is up 5% and the stock exchange stock is up 8%, it gives instant feedback to the regulator that this was not enough.
Yeah, but Samir, to be fair,
that this is such a difficult thing for a few days collectively. You can't come on TV and say it doesn't matter the next time. So I think both will be increased.
No, but to be fair, but Samir, to be fair, these stocks went through a lot of correction, right? Because the announcement was just a culmination of a discussion paper. It went on doing the rounds for several months, and we saw the price damage on an angel.
I'm not joking, but I'm joking. What I mean is, on first day, you have to make it look that it was very tough and not.
Yeah, that's true. It's very, very onerous. Tax hikes, any higher regulation. You have to show that it's very difficult.
But Samir, you're giving the secret away. You're giving the secret. If you got to do it.
Because I'm a transparent guy, I tell everything I feel.
But speaking of transparency, Samir, to round this conversation up as we move to our next guest, who's actually tracking equity markets around the world, CLSA's chief equity strategist. So as we move to Alexander, I'm coming back to the final point, Samir. You are still buying Alibaba, right? So for every incremental, you bought yesterday. So that's the question. That for fund managers, that for all the new money, even if it is tactical short term, are you going to buy China shares or put that money to work here in India?
No, that's what I'm saying. It doesn't happen like that. That fund doesn't buy India. It's a global fund and all. I'm saying India has enough story and an ongoing thing for the world to not take it as a trade-off. And by the way, how much Alibaba we bought compared to what we buy in India, the proportion might be 30:1 or something. So the point is that what I'm saying is this, the fact that China is doing well for a few days, yes, for maybe 10 days, 15 days, it can happen that somebody who's really was short there or really was underweight doing it. But just like you saw today, the GQG guy saying that it's a trade, not everybody will buy into it. And particularly the bigger guys, the endowment type or whoever has walked out of China on some serious view that they have of that market are not even time-wise able to change it in a few days or in a few months. So this will go on, life goes on, but overall it's not a bad thing for China to do well. I mean, because you need the rest of the thing to work well so that we don't stand out also beyond a point that our premium is so much, we are at all-time high relative valuations and
as they say, nazar na lag jaye, Samir, right?
Correct. You have to let it come along.
Super.
All right, thank you very much, Samir. It's a pleasure speaking with you, and hope we can do this more often as we continue to track what's happening in, China, India, and of course everything else. 3-4 things up in the air, all together, guys.
Okay, let's move on then. And as promised, CLSA, let's get the conversation going. CLSA in a recent note said that the China stimulus package is a good start, but not a panacea for China's issue. They added that the constraint on stimulus is already stretched budget and elevated public debt. To discuss more, this and more, we have Alexander Redmond, Chief Equity Strategist at CLSA, joining in. Alexander, thank you very much for joining in. This is Rima here. I think that's the big question now. What we've heard from China and what perhaps might come in the future. Is the Chinese market, should we look at the Chinese market tactically, or is it good structurally for the next 3 to 5 years? Wayne, with your opinion.
Yeah, very good morning. I think that is the key question. What we've seen so far is a commendable delivery on the monetary policy side. We've seen some direct stimulus at getting the equity market animal spirits back alive, and certainly the retail investor has followed through on that. But I think what really differentiates the current episode is going to be whether you get the fiscal follow through from the Chinese government. We've had 4 full storms, so 4 bear market rallies in Chinese equities since March 22. And each one has petered out after about 3 or 4 months and after no more than about 40% gain, as the market has come to the realization that the fundamental economic challenges that China faces have not actually been resolved. What will differentiate this one is if in the next weeks and months we get some clarity from the Chinese government, from the key policymakers in the Politburo, as to the magnitude and the scale and the deployment of a large fiscal package. Because let's remember, China's single biggest problem that it faces at the moment is immense oversupply on the real estate side. If you look at the current inventories with developers versus the current rate of sales, it represents about 3 years worth of inventories that they've yet to clear. And that doesn't include the 12 to 15% of the housing stock in China, which has been bought speculatively. So add all of that up, and you've got a lot of inventory to digest, and you need a sizable fiscal package aimed squarely at local governments to be able to digest that. In other words, buy it off developers and turn it into social housing projects.
So, Alex, great to have you with us here on the program. So you're saying we need to obviously watch the property market very carefully to see if there is any sort of a durable rebound. Is that going to be the best indicator of whether this is the real thing? What else will tell us that this is the real deal?
I need to see multiple changes and indicators. I mean, what we need obviously is for property prices to begin to turn up. Certainly, I mean, this is critical. 51% of household wealth in China is still sitting in property. You know, are you, as a member of a Chinese household, going to feel sufficiently confident to go out and acquire more property if prices are still falling? You know, highly unlikely. But equally, what I would like to see is consumer confidence broadly begin to come up, and also importantly, consumption. And this again is, I think, a key topic, because as we're all aware, China's economy at the moment is still remarkably imbalanced away from consumption. Its consumption share of GDP is only about 56%. If you look at the other large global economies, India included, it's between 70 and 82. So China needs to take policy measures which will unlock savings. At the moment, you have about 115% of GDP sitting in savings. So much of that could be deployed into consumption. It's just whether the government is prepared to take those steps to actually unlock China's consumption potential going forward.
But would you say to some extent this China rally that we've seen is a bit of a hope trade, because this fiscal stimulus package of 2 trillion yen, which has been talked about, hasn't been officially announced by the government there?
Mm-hmm. No, you're right. I mean, what we heard, the genesis of the report, I think, came from Reuters. There was 2 trillion renminbi, split roughly in half. I mean, the idea was that half would go to refinance local governments and allow them to carry on the purchases of excess real estate inventory, and the other half aimed more at stimulating consumption. But as you say, this remains unformulated. I mean, last Tuesday, you had a relatively precise delivery on the monetary policy side and regulatory changes from the PBOC and the securities regulators. And then on Thursday, we had some sound bites that came out of the September Politburo meeting, all about arresting the falls in real estate and trying to encourage spending in China. But as you say, pretty light on detail.
Okay, so got that. So you've spoken a good bit on China. Alexander, the question really is for us sitting here in India is, what does it mean for us? And we've seen the first sign of real FII selling in the last 2-3 days. And I go back to a call that your India analyst Vikash Jain made, that he said the quote-unquote Modi stocks, they are perhaps most vulnerable to profit-taking. So what's the stance on India?
I mean, India's been on a roll for several years now. You know, we've been a structural overweight. We've enjoyed that rally, but I've always been testing that because there is a certain amount of complacency around, or at least has been around the Indian equity market story, and a certain amount of consensus. And there are 3 things which I've been looking at to break that complacency. And essentially, it's an interruption to retail investor appetite. A large pickup in issuance. In other words, you get IPOs to the level that you can swamp the secondary market. And also any changes to the oil price. And what you've seen actually in the last week or so is all 3 of those come into play. So you've seen regulatory changes which have dampened the ability of retail investors to participate in equity derivatives. You've seen the geopolitics in the Middle East become more of a flashpoint, and that's aggravated the oil price as we all sit now waiting for Israel's response to Iran's missile strike. And you've seen significant pickup in primary traffic. So the volume of IPOs and secondary issuance has picked up as well. So all three of those, I think, in combination, are certainly testing the Indian market. And as you say, compounding that, there's certainly some scope for rotation. Now, I think we need to be careful here, because if you look across emerging markets, India is one of the most domestically owned markets, and that is quite a moat for India. It's very protective. 83% of the market is owned domestically. I mean, if you go to Latin America, that number falls below half. And so with only about 17% of India owned by foreigners, and most foreign investors actually sitting, at least anecdotally, at underweight positions because they find it difficult to stomach the valuations, I think there will be relatively little drawdown on Indian equities to rotate into China. I see a more obvious source of that being Japanese equities or Korea or Taiwan as we get towards the end of this tech cycle.
Quick one-word answer, Alexander. On US elections, who's better for emerging market equities? Kamala Harris or Donald Trump?
Look, I think there are some key differences here. I can't really do it in one word, but I'll try and be brief. Look, the differences are, I think, obviously on tariffs. That's very well flagged. We know about that. But equally, there's some more nuanced differences. I think Trump's agenda is far more inflationary. He stands for deregulation, cutting taxes, implementing tariffs. And I think that what that will do is complicate the Federal Reserve's ability to ease in a Trump administration. So I think what would really differentiate Trump and Harris from an emerging market standpoint is three things. One, the Fed's capacity to ease. And that would have a knock-on effect on Asian and emerging market central banks' capacity to follow through. Secondly, the dollar, of course, because if the Fed is unable to cut as much, then the dollar will remain relatively strong, and that's always proved a headwind to emerging market equities. And thirdly, on the earnings side, what brought the EM rally to an end in 2018 was as much the start of the trade war as Donald Trump's tax cuts. He took the tax rate, corporate tax rate in the US down from 35 to 21. What that did was give a boost to US earnings growth. The relative earnings differential between the US and emerging markets then went up, and that made emerging markets overall look less attractive. So what really differentiates on the tax and earnings side between Harris and Trump is that Harris wants to take the US corporate earnings growth back up to 28%. Trump wants to cut it further to 15%. So under that environment, the EPS differential for emerging markets would look better within a Harris administration than Trump. So overall, I would conclude that Harris certainly, I think, is more favorable for emerging markets for those macro reasons.
That's a great point, Alex, and thank you for highlighting that, because there's so much debate around US elections. I think the central issue, which is tax, is perhaps not discussed enough. Thank you very much for all the perspective. Great having you on. We hope to have you more often on the show in the coming weeks and months as well. Take a break on that note, come back on the other side, and we'll connect with Ramesh Swaminathan of Lupin and talk about the company's business outlook.
Welcome back. I think just the one thing I want to say before I get to the next thing is the fact that the bank Nifty came back into the green. There was a big recovery. There has been a decently big recovery from the day's lowest point, and we are now sort of between green and red. So absolutely flat for now. More on this later. Lupin is the first corporate on the program today. The stock surged more than 60% in 2024 so far. We're now joined by Mr. Ramesh Swaminathan, ED and Global CFO at Lupin, to talk about business and some of the developments. Mr. Swaminathan, good morning. First of all, apologies. Sorry to have kept you waiting with markets what they are. So, let's start talking about the latest, right, which is the MyBetric generic. Now, we understand that the US Court of Appeals, the judgment has gone against generic companies like Lupin and Zydus. Could you tell us what is the status of the litigation? Are you still selling this drug right now in the US as we speak? And what is your expectation about how much you will make from this in FY25 and FY26?
Firstly, let me begin by thanking you for having us on. Regarding Mirabegron, the first thing that I would like to state is that it's actually sub judice, so I wouldn't like to delve on it for too long. But I would say that we are indeed selling this drug, and we are pretty confident about our case. And from that perspective, we continue to sell it.
Okay. But this is still in the courts right now. So I understand you don't want to go too much into detail. But the Court of Appeals decision went against generics, right? So will you have to stop selling it at some point, or
It didn't go against the generics, and it got referred back to the same bench. So for the same trial courts. So it is not. I wouldn't say it is actually against generics at all.
Okay. Just one last. I won't press you beyond that. Estimates are that in FY25 you'll make between 120 and 180 million dollars. Is that on track? Or are those wildly off those estimates?
It'd be an unfair question to ask, because essentially we never delve into product-wise details. Suffice to say that we are doing pretty well in the product also.
Okay. Morning, sir. If you could just give us a status on another drug. I think the kidney drug, Jynarque generic. Sorry if I'm getting the pronunciation wrong, because we understand the innovator of the drug, Otsuka, has filed an appeal against a verdict that would have otherwise favored companies like Lupin. So what's the status here? Is Lupin going to launch the drug as you had planned in 2025? Or is there going to be a delay? Or would you look at an at-risk launch?
Just speaking about tolvaptan, the fact of the matter is you've actually won that case, and we are pretty confident about actually launching it. It is a pretty large drug. It's a REMS product, and from that perspective, I would expect it to be limited. It would continue for some time from our perspective, and very, very upbeat about that particular product for the next year.
So when are you launching it, sir?
It'll be possibly in April 25 next year.
And will this be an at-risk launch?
No, tolvaptan isn't an at-risk launch.
Okay.
Mr. Swaminathan, hi, sir. Morning. Now, a slightly broader question. How you're seeing the US business overall sort of move along, and some of your, of course, marquee names like Albuterol, Spiriva generic, etc. So what is the prognosis going forward? And I just want to understand whether politics at all impacts business in any way when it comes to your US operations. Does it really matter to you who comes to power? And also tell us, because it's a little difficult to track all the minute details. For instance, our previous guest was just highlighting that in general, one camp is looking at a big hike in corporate taxes, while Mr. Trump obviously wants them lower. But on the healthcare side, in terms of policies, could there be any significant impact on generic company operations like yourselves?
Too many questions in the same breath. Let me take the first part of the question regarding how well we are doing. We continue to see pretty good buoyancy on the top line in America. So the recent launches, which includes, of course, our respiratory portfolio, Albuterol, and then Spiriva, continue to do pretty well. We've also bought into a few brands out there, Zopinex, Brovana. They also continue to do pretty well. In a general sense, we've also been launching a host of other products, OSD and the like. So if you look at, for example, we had Darnavi last year. This year we had, we had quite a few other products. In this year, for example, we are looking at some ophthalmic products as well. Next year, we're looking at tolvaptan. And of course, when you speak about, in fact, the entire respiratory portfolio, and we are actually working on the entire range of products in that portfolio. And over the next 5 years, we'll be launching a number of products. Apart from that, we also have a number of products on the injectables front also. So from our perspective, we are still pretty bullish about the overall prospects for America. And that would be true with, in fact, the other markets as well. But reverting back to your question about the political situation out there, we believe that affordable medicine is certainly going to be, the case, irrespective of whichever party is in power. So be it the Republicans or is it going to be Democrats, I don't think we're going to be impacted at all. There's of course the IRA and other acts, regulations which might actually impact the ethical companies, not so much the generic companies, because we are all about affordable medicine, and that would not impact us so much.
So, sir, the estimates on the street right now, the analysts are working with estimates of, say, $220 to $230 billion of a quarterly run rate for your US business. Are they fair estimates or are they conservative? Can you actually do better than that? I'm not asking for this quarter, but generally that's the assumption for the next couple of quarters.
I would say that given the pipeline that we have and given the fact that the respiratory products will continue because they're a lot more sticky, I would say the run rate that we saw last quarter would certainly continue in the future as well. So 200, 220, 225 would certainly be the range for the next few quarters.
And around 21% in margins for 25 overall?
Last year, last quarter, for example, we did 23, but we also kind of guided that it could perhaps turn out to be a little lower in the quarters to come because of the fact that last quarter, the overall R&D spends were a tad lower than normal. So given that we were guided for about 20.5 percentage points, very confident that we would actually be on track to achieve more than that.
Okay. You'd also indicated that you could look to spin off some adjacencies like OTC, diagnostics, digital, etc., and get in outside investors. Any movement on that?
So let me put it this way. A capital allocation policy has been predicated on what the board really wants. And when I speak about, in fact, the adjacencies, diagnostics, digital, all of this are very important to us. But having said that, these are not going to be the dominant themes. From that perspective, there is actually the upper threshold in terms of investments that have been kind of prescribed by the board also. We will not be exceeding that. So we already spun it off into subsidiary companies and potentially be looking at involving private equity houses or other passive partners to partner in the journey so that they kind of spin on their own axis. So the idea is, of course, to benefit from these businesses without actually losing sight of the fact that our capital allocation policies should not be kind of dislodged. So it's basically that. So we are confident that when they reach critical mass from our overall size perspective, we should be in a position to kind of place it with outsiders.
Okay, just a quick word. I think the US FDA inspected and issued 3 observations for your Pithampur Unit 1. What's the nature of the observations and what's the status of the facility now?
We are, as I said, so insofar as this facility is concerned, of course, it did go through a recent, the observations are, from our perspective, quite manageable. And we look forward to getting, this sorted out, and with our responses in the immediate future.
Okay, all right. So we'll leave it on that note. Good having you on the show today. Thank you very much for all the perspective and some sense on how the US business is shaping up. Thanks for joining in. Let's quickly move on and now put the spotlight on the consumer durables sector as the festive season is getting into full bloom. Aquarius, in a recent note, has said that industry dynamics remain extremely comforting. To talk about the key trends, we have with us Nilesh Gupta, MD Vijay Sales, and Anand Agarwal, CFO at V-Mart Retail. Gentlemen, thanks very much for joining in. Mr. Gupta, if I could start with you. So what's the sense you have this time around? What is the anticipation? Like festive season last year and compared to this year, what's the kind of growth you are anticipating?
So good morning, everybody. I think this year is going to be much better than last year. Although we had a good season last year also, but looking at the trends which we have seen on the 2nd of October, and yesterday was the first festival day, Navratra, and the way the consumers are coming in, I think we are in for a very good season. That's what.
Do you want to put some numbers to that, Mr. Gupta? How much better could this festive season be versus last year?
So I think we should be looking at a growth of anywhere between 7 to 10%. And mind you, possibly there is more chances of growth, but the issue is everybody maxes out during the season. So even if the consumer demand is more, nobody will be able to do more than 7 to 10% growth. And I think that's the max what can be done in a festive season.
Got that. And can you break that up category-wise? You know, say electronics, what's the expected growth there?
So basically, I think the driver of the Diwali would be definitely electronics would be more, but appliances also does well. So across the category, we find that we'll get a good growth across the category. But one thing which is going to be very good, which we were very skeptical, because last year, the second summer was very good. In fact, the main summer had just got totally lost out because of the incessant rain during the summer. And we had a good second summer, especially in the west part of the country and the south. And this year again, since last 1 week, we have been seeing rising temperatures. So AC growth is also expected. But across the category, I think we'll be seeing the growth.
Absolutely. Temperatures have flipped and how. Gentlemen, good morning, Mr. Gupta and Mr. Agarwal. Prashant here. Mr. Agarwal, if I can come to you, what are you seeing out there? What should we expect from your business and the categories that you're in for the festive period?
I think we remain quite buoyant and optimistic. I think we're definitely seeing better footfalls as compared to at least the last couple of years. This year has definitely been better. There is definitely better consumer sentiment that we are able to witness. Last quarter definitely had been quite good. And the start of this festive, as Mr. Gupta was also saying, I think has been quite promising. The monsoons this year have been very good. So thereby, at least the rural areas or the semi-urban areas where we tend to operate more are definitely looking more promising. We're quite hopeful to have at least, mid to high single-digit like-to-like sales growth. And that's what we have planned in terms of our inventory buildup and what our operations are going to, look like. But definitely, as of now, it's a bit early, but definitely looks very promising.
In Q2, the update that you provided, Mr. Agarwal, same-store sales growth was 15%. What can we expect for the October to December period? I mean, is there any indication at all?
So I think we'll still want to look at least, mid to high single digit. Quarter two is a small quarter, and also we had a benefit of last year low base. But I think quarter three has always been a very, very good quarter, very big quarter. So improving on that on a high base in double digit will be challenging. So I would right now look at, first to get at mid to high single digit.
Okay. Mr. Agarwal, so that explains why I think sort of full year level you're still talking about high single digits, and you're not talking about double digits just yet, right? So, okay, get it. So you're taking a slightly more conservative approach in terms of the guidance. But give us some more color on the revenue that you would hope to do on the back of this kind of same-store sales growth. And also, which are the markets where you're seeing sort of maximum growth at this point in time? Just some more geographical color as well.
Sure. So we're definitely slightly more overweight on East India and South India. We see that as a very, very big opportunity areas. East, particularly, we have not been very strong, but we have built up our portfolio this year in East. In fact, we have opened almost like 15, 17 stores so far in this year in East India alone. And we're quite bullish on South as well. South, as you know, we operate under the brand name of Unlimited. And we're looking at ramping up our presence in South significantly. And we're seeing good results coming in from both East as well as South. So that's two areas where we are definitely working on. In terms of how the overall sales should look like this year, I think we should definitely clock better than what we did last year in terms of the growth percentage. I think if we are able to look at high single-digit same-store sales growth and around 10 to 12% area addition, I think we should be conservatively be looking at around 15% plus at least for the full year.
Mr. Gupta, one final question then. Quick commerce has now expanded to electronics. We know a lot of Indians ordered iPhone 16 on many of the quick commerce sites like, Blinkit and I think Big Basket. How would you assess the threat of quick commerce for a company like yours and the industry?
So I think when online came in, the same question was asked, online has come in, so what's going to happen to the brick and mortar? So the same thing, my answer at that time also was the same, and today also I'll reply in the same way. The best part is in the country, the market is growing. So there's going to be a room for all the players. So there would be consumers who would want to buy instantly and they may go for quick commerce. There would be consumers who are okay to wait but want a deal and they may buy from wherever he gets a deal. And there would be a consumer who say, no, I want the traditional way. I want to go check out. Let us also understand that our product is not something which is discretionary. It's once in a year or once in 3-4 years purchase. People would want to touch and feel also. So I think there's a market for all, and like what online did for the industry, I think quick commerce will do the same. It will grow the market, expand the market. So I'm quite okay. Or rather, I would say I'm happy that more and more interest is coming in our industry.
Mr. Gupta, I can completely concur with you on that one. There are different types of customers and consumers. I'm clearly in the other category. I have trouble, guys, buying like curtains and stuff online. So forget buying high-value items like, phones worth lakhs of rupees. So absolutely, I think there's scope for all kinds of consumers out there. Thank you very much, gentlemen, for joining in. Really appreciate you being with us on the show today. Take a break right now. Come back on the other side. We'll put the focus on the commodity space with Manisha Gupta.
Welcome back. It's flat now. Nagraj Shetty of HDFC Securities is now with us on the show. Nagraj, what would be the index call and the 10 a.m. stock trades?
Hi, good morning, Reema. Nifty has been in a volatile session and we have seen some 1,000 points cut from the highs in the last 4 sessions. So if you look at the similar kind of a decline previously, we have seen similar kind of a knee-jerk actions from the higher levels, and eventually Nifty has bounced back from the lower levels. Market is currently finding a bottom reversal at the lower levels, and I believe that 25,000 to 25,100 is going to be the strong support for the market, which is the 23.6% Fibonacci retracement as well as the 50-week EMA, 10-week EMA. So I think I'm expecting market to bounce back, market to show some bottom reversal around 25,000 to 25,000 levels from the lower levels, and we could see some reversal and a bounce back. The quantum of bounce will determine whether we are going to see the new highs or we are going to see the lower top of the sequence. Right now, I'm a little cautious, and the market is finding some bottoms at the lower levels. And in terms of stocks, I have mixed stocks one from long side, one from a short side. Long side, if you can discuss, the IT has been a phenomenal up move recently, and currently the Coforge is the one from the IT pack is showing upside breakout of the range movement. If you look at the chart of the Coforge, it was resilient during the volatile broader market, and it was actually outperforming the sector recently. I'm expecting currently trading around 7,200 levels. I'm expecting a decisive upside breakout in Coforge. One can look to buy at 71. Currently trading around 7,200 levels, and target would be around 76.50, and one can place a stop loss at 68.50. And one more stock is the Balkrishna Industries from Auto Ancillary. Balkrishna on chartically has damaged recently after the formation of a consistent lower tops. Recently, it is continuing with the lower top formation and decline. The overall chart pattern is looking negative, currently trading around 2930 levels. I'm expecting more declines in this stock. One can look to sell short in Balkrishna Industries, which is currently quoting around 2930 levels. And 2750 is going to be the next downside target for this stock price, and one can place a stop loss at 3050.
All right, Nagaraj, thank you very much for that. So those are some trades coming through. I just want to say that the markets picked up 150 points from the day's low, 50 minutes after market open. The big move is on the upside from the day's low. The day's low is 25,094, just under 25,100, and we are now at about 25,250. So that's been the story. And lots of stocks are moving, which we will get to in just a bit. But commodities is one area, right? I can see oil marketing companies selling off hard once again. HP is down about 3% on my screen, and a few others as well. But let's get the actual underlying commodities and what's happening there. Manisha is here with that. Manisha.
Well, thank you for that, Prashant. I want to take you through crude itself and various scenarios on how the street is working on whether the crude is going down or beyond 80 from here on. So what we are looking at right now is that we've seen 5% of gains in the crude oil prices in the overnight market. And with this now, we are heading to the best weekly gains since Jan 2023. If you look at on how the scenario really has been for the crude oil prices on a monthly basis, well, last month we saw prices decline by nearly 9%. And for the month of October, the prices have gained up by nearly 9%. Now, there have been various reports on whether or not the crude oil prices can go to 80 and beyond. That can happen if Israel attacks Iran's oil facilities. Well, that is something that has been discussed for quite some time now. Remember, Iran is an OPEC member. It produces 3.2 million barrels per day, which is 3% of the global output. Also, Middle East overall produces 1/3 of the global output. So if this spreads around in the Middle East, then we are looking at a concern. And yes, the crude prices can go up. The second scenario is that there could be a retaliation from Israel on the Karg Island, which is Iran's main export facility. So we've talked about on production, and now it's about export. Iran actually exported almost 1.8 million barrels per day in the month of August. So that is something that can be immediately impacted. The third scenario is on whether or not the crude prices can go to 80 and beyond is if Iran disrupts oil flow out of Strait and Hormuz, and this would be most critical and crucial because this is where what would choke almost all the crude oil that comes in from Middle East. So these are the three scenarios that the street is working with. If any of this happens over the weekend going forward, then yes, you are looking at crude oil prices at 80 and beyond. Apart from that, when you look at the Russia-Ukraine conflict, when that happened, we did see the crude oil prices go to $130 a barrel. But then it did not sustain there, and we saw the prices come down quite sharply. The pricing closing for 2023 2020 was 85. When you look at the last year, the range has been 73 to 93. Range until now this year has been 70 to 91. So we are far away from the highs of this year at this point in time, even as we're looking at various concerns there. Now, when you look at the global supply-demand mismatch, that is what is weighing onto the prices right now, is the reason you haven't seen 80 cross by right now. So OPEC and allies spare capacity is quite high, much more than what Iran produces. Apart from that, the Libya oil production is coming into the markets. You also have weak Chinese demand. The US production has been on the higher side. So in sense of supplies, we are very comfortable and demand really not picking up. Now, going forward from here, it really is going to be about the US non-farm payroll data that comes in today. And then, of course, you have the US presidential elections coming in the month of November, and they wouldn't want the crude oil prices much higher. So it's going to be a very interesting next 1 month on what really crude does in light of all of that.
Thank you very much for that. With that, it's time for a short break. Don't go. On the other side, Lata will be in conversation with a host of experts to discuss if RBI follows the US and cuts rates on October 9th. Stay tuned.
The upcoming Reserve Bank's monetary policy is much awaited for a bunch of reasons. Three big central banks in the world have cut rates and cut rates substantially. The Israeli war is about to escalate, and the MPC has 3 new members. So let's turn to our own experts. CNBC-TV18 Citizens MPC is here for their deliberations. Chairman Pranab Sen and members Sajid Chinoy of JP Morgan, Soumya Kanti Ghosh of State Bank, Samran Chakrabarti of Citibank, and Sonal Verma of Nomura. Gentlemen and Sonal, as always, thank you very much for joining in. Sajid, I'm going to start with you because of the global backdrop. The Fed has cut more than expected. The upcoming Reserve Bank's monetary policy is much awaited for a bunch of reasons. Three big central banks in the world have cut rates and cut rates substantially. The Israeli war is about to escalate, and the MPC has 3 new members. So let's turn to our own experts. CNBC-TV18 Citizens MPC is here for their deliberations. Chairman Pranab Sen and members Sajid Chinoy of JP Morgan, Soumya Kanti Ghosh of State Bank, Samran Chakrabarti of Citibank, and Sonal Verma of Nomura. Gentlemen and Sonal, as always, thank you very much for joining in. Sajid, I'm going to start with you because of the global backdrop. The Fed has cut more than expected, and so has the Chinese PBOC. Won't this prevail on the MPC? To what extent?
I think the global environment is actually far more nuanced than is believed. One would get the impression that with the US labor market slowing and the Fed announcing a 50 basis point cut, that the US is hurtling into recession. But that's not actually the reality on the ground. If you look at the Atlanta Fed, in their estimate, third quarter in the US, July to September, is actually tracking 3%. very far from any recession. And if you look at the internals, both consumption and capital expenditure are holding up. So in fact, the US resilience story has gotten more support in recent weeks. Now, despite that, we think the Fed will continue cutting because they have more confidence about inflation. And, the Fed's estimate of its neutral rate is somewhere close to 3%. They're currently, even after cutting, they're at 5%. There's a lot of space for the Fed to cut. So you could still be in this Goldilocks situation where the US is resilient and the Fed is cutting, and monetary conditions, not just in the US, but around the world are easing because once the Fed moves, many other central banks move. And when monetary conditions ease that much, you're actually buying insurance for 2025 growth. Now, this is not to minimize the near-term risk of a recession. We still think there's about a 35% chance the US slips into recession this year. But if they don't slip into a recession, the Fed easing and the monetary easing around the world actually argues for higher growth next year.
Can we be that sanguine about the crude angle now that there seems to be an escalation? Sonal, until last week, one could be a little more sanguine about the global situation. But with the war escalating, do you think the Reserve Bank has to pencil in more uncertainty and therefore should not ease too soon?
Lata, I think, if we look back at the last 2.5 years, we have had nothing but uncertainty to deal with. And particularly the geopolitical tensions is something we've had like periodic episodes of escalation. And clearly we are in one right now, which is putting an upward pressure on prices. So in terms of, how this plays out, and the uncertainty is something that we don't know how it's going to play out. That said, I think if you compare where we are today versus where we were back in August, we were actually above $80 per barrel on oil prices. And today, with this geopolitical risk premia being built in, we are basically somewhere around mid-$70 on oil prices. And specifically for India, the oil marketing companies are actually sitting on a large cushion in terms of margins. So in terms of the pass-through to domestic prices actually should not be there. And RBI in its projections has been working with $85 per barrel on Indian basket of oil. So I think we have more than enough cushion. And I think the other angle to look at is also the impact the uncertainty is going to have on investments and growth going forward. So there's also the demand angle to keep in mind. So I think, yes, there is uncertainty, but I think we have enough cushions.
No, I take your point. I'll, time permitting, come to the geopolitical angle again. But Samiran, first let me tackle domestic inflation. After all, the Reserve Bank reiterates it looks at domestic factors. And here, as Sonal points out, $74 is not hell for us. We've seen worse. And what about food? We saw 2 months of food coming down slightly, though not across the board. Will that still be a good reason for RBI to worry?
At it is that the base effect-led decline in inflation is now behind us. Now the base effect will turn adverse. And even if there are no significant new price pressures, we're still going to see 3 inflation prints which are close to 5%, if not more. So that situation could worsen further if we see that this tail end of the monsoon being much stronger than usual, leading to some increase in vegetable prices, and that feeds into things. The second risk to look out for is what we were discussing from oil prices, though maybe not as much of a risk for India because retail prices are unlikely to be hiked anytime soon. And the third is from the China stimulus. If this persists, if China also goes in for a fiscal stimulus on top of the monetary stimulus, then the commodity price increase at a broader level, particularly with respect to metals and all, and gold, that could feed into the inflation forecast as well. So these are some of the upside risks that we have to look at in the short term. However, we are very conscious that whatever exclusion-based core inflation measure one looks at, they're all very benign. So it's not that there is a huge inflationary bias for the overall economy. And RBI needs to make a difficult call between actually waiting to see the inflation prints turn to 4 versus taking a call on their forecast, how forward-looking they are going to be to see that 4% being met on a durable basis. I think that's the critical challenge that one needs to look at.
Point taken. And in that critical challenge, growth appears to be pleading for a bit of softness from policy. Shaumya, would you agree that the August-September numbers on so many things, core sector, IIP, PMI, seem to be indicating that the economy is softened in the second quarter? So will growth be a reason for the Reserve Bank to be dovish?
Yeah, thank you, Lata. I think yes, there is evidence of growth slowing down. If we actually look into the leading indicators, more specifically the consumption-facing sectors in terms of two-wheeler sales, in terms of passenger vehicles, in terms of tractor sales, I think they're all showing signs of a slowdown. And particularly, I think August and September months could see some signs of a slowdown, definitely. And also the fact that if you look into the latest bank credit data, that also saw a significant perceptible slowdown. Even in incremental terms, if I adjust for the merger last year, the total incremental credit growth for like-to-like period till the end of August was actually 2 trillion down from last year. And for the first time in the last 2 years, the gap between the credit and deposit growth is now narrowed down to only 220 basis points. And in fact, on a year-to-date basis, the deposit growth rate is running much higher than the credit growth. So yes, there is evidence of credit growth slowing down. The indicators also showing that there could be some soft patch of data which could come through in the next couple of months. So my sense is that it may not be the time to say that growth is going to slow down because we need to see some more evidences. But one point on the table is clear, given the current geopolitical conflict and the talks of an war getting elongated or getting prolonged or getting broad-based, I think what should be also on the table on the Reserve Bank to address the growth concerns to be the financial stability concerns. So I think overall, the Reserve Bank faces a delicate situation, but for the time being, I think it could still ride through with perhaps a message that there should need to be some sort of an hand-holding in terms of growth, even though the evidence is not clear yet in terms of an perceptible slowdown in growth numbers.
Dr. Sen, if you can combine all these points and also the fact that, what Sonal pointed out, despite the fact that there have been rate cuts, despite the fact that, the US GDP growth is 3%, despite the fact of a fairly elevated escalation of tensions, crude is only $74. I mean, we have seen 80, 90 as recently as April. So it looks like the global growth is not so strong, demand not so strong. Is that an interpretation the RBI has to take both domestically and globally, that growth is not so strong?
Well, no, I mean, the RBI will have to take into account for sure. But the point is, how important is it? If you really look at what effect the global economy has had on the Indian economy, which is really the focus of RBI's action, it hasn't made much of a difference. And we've been talking about this for a while now. And all the prognosis that have made don't seem to have been borne out by the developments. So I don't think what is happening globally is going to worry RBI that much. The bigger concern, I think, is what is happening domestically. And there, I think there's a whole bag of mixed signals coming. Shombo just pointed out to a series of data points which tends to indicate a certain degree of softening. But there are other data points which seem to suggest that if nothing else, at least private investment seems to be picking up. So I suspect the RBI is going to be focusing much more on that. Right? And that, to my mind, is really the key issue, that there is a huge amount of uncertainty, global uncertainty for sure, But I think there's greater uncertainty on the domestic front. It doesn't seem to, I don't think any one of us can take a judgment call and say it's going up or it's going down. I mean, it's still moving around, which means that one needs to be flexible.
Let me ask you all to take your electronic machines and vote. What will the Reserve Bank and the MPC do to rates? Let me start with you, Sajid.
Hold rates, they'll pause.
Hold, okay, hold. Shaumyo?
It's
hold. Okay, Sonal?
They should cut 25 basis point.
Here's the first cut. Samiran?
No change.
3:1, sir, in favor of hold. Dr. Chairman?
Hold.
Hold. Okay, so it's 4:1 in favor of holding the policy. Change of stance. Will the MPC change its stance from the current withdrawal of accommodation? Sajid?
Change to neutral.
Oh, okay. Sonal?
Change to neutral.
Obviously, you voted for a cut. Samiran?
Hold on to the stance, but it's going to be a close call.
Okay. Shaumyo?
We'll hold on to the stance.
Okay. 2 holds, 2 change to neutral. Dr. Sen?
Change to neutral.
Change to neutral. I think your members are veering to your point of view. It makes it a very interesting policy. Bazaar viewers, you will get to see the whole show after market hours. For you, it's time for Chartbusters.